Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another edition of the What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. And point number 1 is a good point after 3 point number 1s that have been bad for the last 3 weeks. The market broke its 3-week losing streak thanks to very strong economic data that was released on Friday regarding the state of the U.S. economy. Similar data was also released regarding the strength in the Eurozone and China. And in my opinion, probably the most bullish signal we received Friday was from the U.S. services industry. Now, they reported the ISM Services PMI data. That's a lot of alphabet soup, but effectively what that means is the Institute of Supply Management said that the most companies that they surveyed were positive about current business conditions. Their reading on this survey came in at 55.1, which was a slight drop from last month where it was 55.2. And essentially what you need to know about that number is anytime there's a reading over 50 on that index, it indicates expansion. Companies think that are being surveyed in this, things are going in the right direction. Now, why do I say I think this is the most important data in my opinion? Well, think about our economy. 2/3 of our economy is you and I spending money. Typically, we spend money in the service portion of our economy. Therefore, when this reading, the Service Industries Index, is strong, as you can see from your screen, it means that the U.S. economy is probably running at a good clip, as it has most of the last 5 years, as you see, except for COVID and a brief stint last year. Both the services sector in the Eurozone and China were equally strong, pointing to strength in global spending on services. Now, before we look at the returns for the markets for last week, let's recap February, since February was actually ending this week. For the month of February, the S&P 500, which is our proxy for growth and growth in income stocks, but only when taken together, including both of those categories, that was down 3.62% for the month. The Russell 2000, which tracks our more aggressive growth, smaller companies, was down 3.24% for the month. And finally, the MSCI EAFE, which tracks international stocks across the world, excluding the U.S., was down 2.75%. That means international won the prize for the month of February. They lost the least. Now, markets are still up on the year thanks to a strong January. And for the week, the S&P 500, again, our growth and income proxy in our Dave Ramsey vernacular, that was positive 1.9% for the week. The Russell 2000, our aggressive growth proxy, was up 2.21% for the week. And the MSCI EAFE, again, that tracks our international stocks, excluding the U.S., was positive 2.65%. So international lost the least in February and nearly made it all back this last week, being the best performer for this week. Point number 2, Warren Buffett. Now, Warren Buffett, who's Warren Buffett? Warren Buffett runs Berkshire Hathaway with his business partner, Charlie Munger, and they are the definition of great long-term investors. Berkshire Hathaway is much like a mutual fund in that their company is actually a conglomerate of many companies. That's why I think it's so funny when Warren Buffett says he thinks you should only buy the S&P 500, which of course we're not against for a portion of your portfolio. But however, isn't the saying, do as I say, not as I do? Well, his investment, which he would gladly love for you to invest in, is an actively managed conglomerate of many companies, which is almost the exact definition of a mutual fund. So it's just really well ran by himself, Charlie, and their team. So sometimes you don't always listen to what they say, you see what they do. What they do is run a mutual fund effectively. Last week, Warren Buffett, who is not a conservative politically, wrote in his annual letter, and he took a major swipe at President Biden. Let me give you an excerpt of the annual shareholder letter from Berkshire Hathaway, which of course is written by Warren Buffett, talking about stock buybacks, which is what I want to talk about in point number 2. It says, when you are told that all repurchases, stock buybacks, are harmful to shareholders or to the country or politically beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. Ooh, that was in direct relation to President Biden's State of the Union, where he criticized big oil companies that use record profits to buy back stock. He proposed in that speech quadrupling the current 1% federal tax on buybacks that just went into law this January after President Biden pushed that through last year. And before we got our divided government, I should say. And now, what are buybacks? Let's talk about them for a second. And are they truly bad for the investors or workers? In the fourth quarter of last year, Apple, who probably all of you watching this video own through your funds or individually, they spent roughly $19.5 billion on stock buybacks. Meta, the parent of Facebook, they bought back $6.9 billion of its shares. And Microsoft, a large holding in many of our funds, they repurchased about $5.5 billion of stock. This year, Chevron announced a $75 billion buyback program, while Goldman Sachs, a large investment bank, they announced a $30 billion authorization. Now, what happens for you as a shareholder when these shares are bought back? It does two things very generally, okay? The first thing is it increases demand for the stock because they're buying back all this stock, which can typically raise the share price. And then, secondly, there are fewer shares outstanding in the markets, so it has the effect of lifting the earnings per share number without increasing earnings. Now, that is extremely helpful in a high inflation environment where earnings growth can be hard to come by because everything's costing more for you individually and the company. Thus, it's harder for them to get earnings growth. So buybacks are actually a great thing. Why do some people hate them or purport to hate them? Well, first off, you got to know, it sounds good politically. But just as Buffett said, they don't understand economics. Maybe in another video, I'll get into why they don't hurt the economy, or more particular, the workers, or hurt the company's ability to hire new workers or give workers raises. No. In fact, it only helps the company's ability to give you a raise or to hire new workers in the future when they do a stock buyback. But again, you have to understand economics and know that. We'll talk about that in another video. Point number 3. Let's talk about the thing on everyone's mind, interest rates right now. Right now, the CME Group FedWatch tool, as of today, March 3rd, Friday, has the March meeting estimate still at the Fed increasing interest rates 0.25%, 0.25. However, look at what I circled in the bottom right corner. A month ago, there was a 0 chance of them doing a 50% increase, and now that has jumped to nearly 30%. This is important because it would deviate from the Fed's playbook historically, where they increase as the appropriate amount and then either stop all increases or gradually slow them down. Going from 0.25, where they landed last Fed meeting, back to a higher level of increase would mean the Fed is admitting they were wrong in slowing down their rate hikes, and that could be problematic in the short run for the markets. For example, the 1994 rate increase cycle looked like this. There were 3 increases of 0.25%, then 2 increases of 50 basis points, then 1 increase of 0.75%, and then a slowdown to 50, and then eventually they just stopped it. No more increases after they started going down. The 99-2000 playbook was similar, where they had 4 0.25% hikes, then 1 final 50% hike before they stopped everything. And the 2004-2005 cycle was 17 rate hikes of all 0.25%. Then, of course, 2015 to 2018, our most recent rate hike cycle, saw 9 hikes of all 0.25%. The point is here, they either decelerate or they just outright stop. A reacceleration would be outside of this historical playbook. So let's see what they plan to do on March 22nd. And we'll certainly continue to watch the CME Group's FedWatch tool to get a framework for what's probably going to happen. And point number 4, finally, let's talk about Meta, the parent of Facebook, which of course is a large holding in many growth funds. Now, let's learn about a release they made this last week. They talked about their virtual reality glasses. They plan to release the first pair in 2025 alongside a smartwatch that is designed to actually control the glasses. Now, these are mixed reality glasses, which means you are partly in the real world while partly being in a virtual world. Take a look at this photo I was able to retain from The Verge, who actually got this release this week. Here you can see the person is playing chess with their friend who is presumably far away, but able to act like they're sitting at the same table thanks to these glasses. They want these glasses to be higher resolutions and nail things like helping with work, your text messages, and other things which the current version of virtual reality products do not do a great job around. They're not the only ones working on this, by the way. Apple is expected to announce a high-end virtual reality headset sometime this year. Sony just released the PSVR 2 for PlayStation users. Now, this is a online virtual reality for playing video games. From an investment perspective, the Meta Frames, they think this opportunity will be around 2 billion pairs of regular glasses and a couple 100 million of smartwatches that could be sold each year. In addition to the amount of advertising revenue that would be available on these virtual reality products. And that's probably an insurmountable billions of dollars worth of opportunity set right there. So certainly something to be watching, and a pretty interesting release that they had this last week. So if you thought the 4 things in the markets were helpful to you, would you do a favor to us? Would you do a favor to us by hitting the subscribe button? That allows more of our content to be pushed out to you, such as these videos, our question of the week video, and any other videos we release that are more topical. As well as, would you hit the like button? That like button helps with Google and YouTube's algorithms and gets our content out to more people. In addition, if you would like to meet with any of our financial advisors or financial coaches, our financial coaches who help you get out of baby steps 1, 2, and 3 with budgeting help, debt pay down help, or anything in regards to keeping you accountable with your financial goals, they're there for you, as well as our financial planners who typically work with clients in baby steps 4, 5, and 6 to help you start saving your 15% so you can eventually live and give like no one else. Thank you so much for watching this video. We'll look forward to seeing you next week.